how to evaluate profitability or performance of a business from the perspective of capital providers. So, if I have to evaluate a business from the perspective of the people who have given capital to the business, I will calculate four ratios. Of course, I can keep on adding more ratios to this list, but because of the limitation of time that we have, I would focus on four ratios. Which are those four ratios? Those four ratios are number one, earning per share. How do I calculate earning per share? Net profit divided by the number of shares will give me an idea as to what is my earning per share. How the earning per share is important, I have already explained to you. Then I will calculate the CEPS, cash earning per share. How do I calculate the cash earning per share? Again, very simple. Cash profit divided by the number of shares, and that will give me cash earning per share. Then I would need to calculate something which is known as return on equity. How do I calculate return on equity, friends? It's very simple. So I will calculate return on equity. So if I have to calculate return on equity, what will I do? I will take the earning after tax and divide it by the net worth of the company, and that will give me my return on equity. So earning after tax or net profit or profit after tax divided by the net worth of the company, and that will give me net worth of the company, or you call it equity, both mean the same thing. So that will give me the return on equity. The fourth ratio that I calculate for evaluating performance of a business is known as return on capital employed. How do I calculate return on capital employed? It's very simple. Return divided by capital employed into 100, and this will give me my return on capital employed. So these four ratios will give me an idea as to how the company is doing from the perspective of the people who have given capital to this company. And that's your these four ratios: earning per share, CEPS, cash earning per share, a return on equity, and return on capital employed. Now friends, what we will do, we will take few small case studies and calculate these ratios together. So let us so close we calculate these ratios together, and before we calculate these ratios together, let us also understand the third perspective for evaluating profitability of a business. And the third perspective is from the assets utilization perspective. So profitability of a business, please remember, can also be understood from the perspective of assets utilization. How do I calculate the assets utilization? How do I evaluate profitability of a business and find out how efficiently the company is using its assets? And this is return. I is for investment into 100, and this will give me my ratio return on investment. And now what we do, now we calculate all these ratios. So we will calculate the return on equity, we will calculate return on capital employed, and we will also calculate the return on investment. So here is a small case study for all of you. Please find out as to what should be the return on equity. So what should be the return on equity? Now there's a what you can do, return on equity. So this is how you will read it, return on equity. So please find out return on equity should not take you more than 30 seconds.